Welcome back. A researcher in Cyprus has discovered a strain of the coronavirus that combines the Delta and the Omicron variant together, according to Bloomberg News. Leontios Kostrakis, professor of biological sciences at the University of Cyprus, has called the strain Deltacron. So, after Omicron, next is Deltacron. It's still too early to tell whether there are more cases of the strain or what impacts it could have. Now, this is something which would catch people by caution, and the world would be looking as to whether there are further developments here. Now, there are Omicron like genetic signatures within the Delta genomes, and this is what the scientist has reported. So far, Kostrakis and his team have found 25 cases of the virus, according to the report. It's still too early, though, as I explained. We'll see in the future if this strain is more pathological or more contagious, or if it will prevail against the two dominant strains, the Delta and the Omicron. And this is according to Kostrakis, who believes that Omicron will also overtake Deltacron in times to come, which it already is beginning to. The researchers sent their findings this week to GISAID, which is an international database that tracks viruses. The Deltacron variant comes as Omicron continues its rapid spread across the globe, causing a surge in COVID-19 cases. United States is reporting a 7-day average of more than 6 lakh new cases daily, according to an analysis conducted by CNBC of data from the Johns Hopkins University. Now, that's a 72% increase from the previous week and a pandemic record. So, naturally, there are concerns. The only good thing or the silver lining is that this strain of Omicron is less lethal, causing less deaths, and therefore it's easier to handle. The admissions to the hospital have also been much less, and that is something which has come as quite a silver lining, and people have not been so perturbed. Although there are many countries which have gone into semi-lockdown conditions, including many countries in Europe and in Asia, like India, have gone into many states have gone into semi-lockdown condition. As we begin this week of the second week of January 10th onwards, you find that there has been a sharp jump in bond yields to start the year. Okay, global bond yields have really shot through the roof, and these rising rates could once again set the tone for stocks next week. Big events include testimony from Fed Chairman Jerome Powell, and that's on Tuesday, and of course the inflation reports on consumer and producers prices, which are extremely important again. The week also marks the beginning of the fourth quarter earning season, with big banks like JP Morgan Chase, Citigroup and Wells Fargo reporting on Friday. So going to keep the markets on tenterhooks, so as to say. The bond market could once again set the course for the week ahead after rapidly rising interest rates gave stocks a choppy start to the new year 2022. And you have key inflation reports, which, as I explained, are always critical. And Federal Reserve Chairman Jerry Powell stated to testify on Tuesday at his nomination hearing before a Senate panel, while the hearing on Fed Governor Lael Brainard's nomination to the post of vice chair is set for Thursday. Okay, so these are all many events. While you have the nomination hearings, you hear these many voices which can also have an impact on global markets. Inflation and the Fed therefore continue to be the theme next week, but I do think that we are looking forward to having some earnings result to sync as well. And it's going to be good quarter as far as earnings is concerned, but inflation and the Fed guidance will definitely set the stage of more volatility in times to come as far as global stocks are concerned. As you know, stocks had a rough first week to 2022, as bond yields rose on both high expectations for Fed interest rate hikes and the view that the Omicron variant of coronavirus is headed for a peak in a matter of some few weeks across the globe in general. Yields move higher when bonds sell off, as you know. Tech was particularly hard hit in this first week of 2022, with the Nasdaq Composite down 4.5% for the week, while the Dow was barely negative, down just 0.3%. The Technology Select Sector SPDR Fund was off 4.6% as of Friday afternoon. But banks moved higher on the prospect that rising interest rates would help their earnings and improve their net interest margins. The Financial Select Sector SPDR Fund was up 5.4% for this week. The S&P 500 ended the week at 4677. It was down 1.9%. Now this week was a wake-up call for what we are going to be dealing with for 2022. Lower returns and more risk. So welcome to 2022. Yields rose rapidly across the curve, but the dramatic move of the benchmark 10-year was particularly rattling and unnerving for investors. The 10-year, which influences mortgages and other loans, rose from 1.51% in the final hour of 2021 trading to as high as 1.80% on Friday. That makes it the second biggest move in the yield for the first week of the year in more than 20 years, as far as statistics gathered by Wells Fargo. It's more dramatic than what we had anticipated, and the Fed's pivot to a more hawkish stance has been the biggest surprise to this new year. Most market participants, of course, expect higher rates, less accommodative monetary policy, but when you look at the Fed funds implying a 90% chance of a hike in March 2022, on that New Year's Eve, that was just 63%. So from 63%, now we have 90% chance of the Fed hiking interest rates in March. That's been a pretty dramatic change in one and picked up in the Fed minutes this week, and the markets are adjusting to that, and so we are seeing nervousness. Powell's hearing, of course, on Tuesday will be a highlight of the coming week, not because he's expected to make any news, he's already in, but because he's likely to echo the tone of the Fed minutes released last Wednesday. The central bank revealed in those minutes that officials are also discussing when to start shrinking its nearly $9 trillion balance sheet. The Fed has already forecast tightening policy with 3/4 point interest rate hikes this year, and downsizing its bond holdings would tighten it even further. Okay. And bond investors have also reacted to the December jobs figure on Friday by sending interest rates higher. There were just 199,000 jobs created last month, and that was less than half of what was expected. But the unemployment rate fell more than expected to 3.9% from 4.2%. Average hourly wages rose by 0.6% or 4.7% year over year. Now, economists do blame, of course, the weaker report in part on a lack of workers to fill the jobs, but the Fed is expected to move to hike interest rates regardless. All these are going to keep the markets on tenterhooks, and global markets and global investors will sit on the edge once again. As I've explained in another video of mine, I believe the coronavirus wave will continue in various forms and variants till about end of February and sometime in March. Then we'll see an easing of the situation, and we could see the beginning of the end in a very bold prediction made by me on coronavirus. Another thing to remember is this week there could be a negative momentum on Wall Street, yet there will be at least one very good day where there could be a sharp rise in the Dow, S&P and Nasdaq. To be a part of my various premium groups, okay, those focus on two indices currently, Dow Jones, S&P 500, that we have a package, and then another one is pertaining to Nifty. Nifty, we have 2 days outlook, 10, 12 days outlook, and of course a 30 days. So we have 3 different programs over there. You can join any of these by emailing me at globalmoneyinvestor@gmail.com, globalmoneyinvestor@gmail.com, or you can WhatsApp me on 982 086 1044. Have a great investing week ahead. Take care. Bye bye.